Hello everybody. Firstly, I'd just like to welcome you to this webinar where we'll be talking about crude oil and whether its recovery after hitting an all-time low can continue in the midst of the economic impact of the coronavirus. My name is Sasha and I'm a finance analyst from the research department at Trade. Delighted to have you with us. If you have any questions, please call us and ask to speak to a senior account manager who'll be happy to help. Before I go any further, please take a moment to read our risk warning and disclaimer. I'm sure you know that although gains can be made trading CFDs, losses can be incurred too, and you need to be aware of this. And now let me explain what market opportunity is if you don't know. A market opportunity is a one-page briefing containing market analysis, and our goal is to provide you with a simple to understand opportunity to trade in the markets. We will select an instrument such as gold or a currency pair and tell you our very best estimate on the direction so that you can trade on it if you want to. Market opportunities are produced by the research department on a daily basis according to market conditions. A market opportunity consists of fundamental analysis, geopolitical events, and technical analysis that includes a pivot point and some resistance levels. It's important to understand it's your decision whether you want to trade on market opportunities or not. Here's an example of a market opportunity. You can see fundamental analysis on what's going on with the euro-dollar currency pair. You can see that this is a downtrend opportunity over a weekly period, since our analysis suggests the euro would decline in value against the dollar. At the top, you can see some geopolitical events and fundamental analysis that can influence the euro-dollar currency pair. For example, the part on the EU and its disagreement with the Italian government over its budget, which in the past put pressure on the euro. When using a market opportunity, it's vital to look at the pivot point on which the calculations are based. In this instance, if the price reaches 1.1381 that you can see on the right-hand side of the screen here, this shows the right moment in our estimation for opening a trading position had you decided to trade on this market opportunity when it was active. You can see below the trend direction and the time period. It's also important that you know how to use the stop loss and take profit options. You have support and resistance levels further along. At these points, you can put a stop loss and take profit, and further down you have calculations. If you close the position using take profit, you can expect these kinds of bits at the support levels marked in green. If the price is going against you, you can potentially have a loss of amount at the resistance levels marked in red. Finally, profit and loss calculations are based on a one-lot trading volume. So first, let's talk briefly about OPEC, recent developments, and then we will cover what's going on with prices at the moment. It's important to understand the role of the Organization of Petroleum Exporting Countries, OPEC, is many of the largest oil producers in the world, including Saudi Arabia, OPEC's key player. The organization generates some 44% of all world oil production. It agrees jointly whether to increase the production of oil, which should influence prices down, or to cut oil production, which should help push prices up. The previous production deal limited production to 1.2 million barrels a day. The OPEC deal, expired on March 31st, 2020. The last OPEC meeting was highly anticipated. That's the meeting on March the 5th to March the 6th, although it lasted longer. It was highly anticipated since Russia had already shown it wasn't willing to make production cuts. This put pressure on crude prices before the meeting, but prices plummeted after Russia refused to approve OPEC's proposal to cut production by an additional 1.5 million barrels a day. So the coronavirus, the lack of crude demand, and the lack of an OPEC agreement, that is oversupply, combined to push oil prices as low as $19.2 per barrel on March the 30th. Following the meeting, an angry Saudi Arabia stated it would increase production to a record 12.3 million barrels a day. Russia responded, saying it too would increase oil production. OPEC and Russia met at a virtual meeting on April the 9th, after intervention from President Trump. In fact, on April the 2nd, crude prices jumped by 24%, its highest ever one-day gain, after Trump tweeted Saudi and Russia had agreed in principle to a 10 million barrel cut. That's 10 million barrels a day. However, both Saudi Arabia and Russia told Trump to put pressure on US shale companies to cut production too. US oil companies are private, and the state can't manage production as it does in Russia or Saudi Arabia, though. Russia also sought US concessions in freeing its oil companies from US sanctions. However, no deal was reached on April the 9th or April the 10th when they met together, and crude prices slumped. Finally, a deal was reached on April the 12th. The deal was to cut output by 9.7 million barrels a day to support oil prices, representing around 10% of global supply. Analysts had hoped that OPEC would cut almost 15 million barrels a day. But there was progress on getting the United States, Canada, Brazil, and Norway to commit to cutting a further 5%, or 5 million barrels a day. Let's see how this impacted the markets. Investors were not overly impressed with the deal. You can see that prices sank on April the 10th and 11th as fearful investors worried that there might be no deal. On market opening, you can see how crude oil prices bounced higher but fell again to between $20 to $23. Markets didn't believe that the cut was enough to offset declining demand caused by the economic impact of the coronavirus. Many traders believed that crude oil had further to fall. On April the 21st, crude oil prices slipped to all-time lows. On the demand side, the world had come to a standstill, with economic activity and demand for crude oil at very low levels, as everybody stayed at home and international air travel stopped. On the supply side, there was a consensus among investors that the OPEC deal was not enough to stop prices falling. There were reports that existing oil storage were filling up, and soon there would be nowhere to put unused oil. Instead, a number of container ships floated offshore, being used as offshore storage for crude oil. At the same time, crude oil prices rolled over from 1 month's contract to the next, causing a sell-off. Actually sent the previous month's contract into negative territory. That's below zero crude oil prices, something never seen before in the history of crude. On our platform, though, you can see that crude oil bottomed out at just $6.44 per barrel. But prices then jumped higher. Here you can see crude oil prices over the past month and understand how volatile prices are. Crude oil is around 2% higher over the past month, but entered an uptrend since April the 28th, skyrocketing by some 120% since that date. So what's going on? Crude oil prices hit a 4-week high last week. First, the OPEC deal has come into force, and reports from Russia and Saudi Arabia suggest that both countries are honoring the agreement. Both appear committed to cutting production and to support crude prices. Second, on the demand side, we are seeing increasing optimism over the opening of the global economy. Lockdowns are ending in many US states and countries around the world, and economic activity is increasing. China last week released better than expected data, including increased exports during the coronavirus, despite an expected decline. Investors believe that these are signs that China is recovering more quickly than hoped, and that demand for crude oil is about to increase. China is one of the top consumers of crude oil, so this fact alone is significant for crude oil prices. Third, to return to the supply side, last week we saw better than expected data from the American Petroleum Institute and Energy Information Administration, showing that US inventories are not filling up as quickly as investors feared. This also suggests that US crude oil producers are cutting production. Another factor to bear in mind is that some US shale companies that produce crude oil have already gone bankrupt, removing their oil supply from the market. These US oil producers have been responsible for record amounts of crude production, which has put so much pressure on prices in the first place. So what's the outlook for crude oil and the danger posed by the coronavirus and oversupply? The immediate future for crude does not necessarily look good. Output is still too high and demand is very low. However, markets are looking forward to the future. Investors are basically projecting a scenario that will see the global economy open up and recover to previous levels of demand and witness higher economic growth and higher inflation in 2021. There are some dangers which could push prices back down worth thinking about, though. The main one is second or third wave of infections, which could break out after countries and US states lift restrictions. This might cause another shutdown and to delay an economic recovery further, and could suggest more shutdowns in future as more waves hit. Early this week, traders were getting nervous about figures in China, South Korea, and Germany about the coronavirus, all showing rising numbers of infected after these lockdown measures. Any news of this type will put downward pressure on crude oil stocks and cause negative sentiment in markets. And of course, a delay in crude oil demand will mean crude oil stocks will continue to fill up, meaning the oil glut will continue. On the other hand, if there is no second or third waves, or if they are controlled well, markets will assume that a quick economic recovery is possible. Data from China last week, as I mentioned, suggested that the country is recovering more quickly than expected. This positive news would be expected to push crude prices upwards as demand for crude oil picks up. In fact, Goldman Sachs stated last week that crude prices will average $51.3 next year, raising their previous prediction. Alongside the OPEC cuts, we are seeing US shale companies cutting back production too. So, over the long term, traders are optimistic that the market will rebalance and prices will rise. Of course, we at ForeTrade will be following any developments that affect crude oil prices very closely. And that means above all anything to do with the coronavirus. So please do get in touch with the senior account manager if you have any questions or want to take advantage of multiple trading opportunities that these volatile markets are currently presenting. Until next time, goodbye, and please join us at ForeTrade again soon.